Hey everyone, and welcome. Today, we're going to tackle a word that, let's be honest, can make a lot of people feel a little nervous investing. But what if we looked at it differently? What if it wasn't some impossible puzzle, but actually an exciting journey? Well, we're here to help you draw the map for that journey. So let's dive in.
You know, any good journey needs a destination. For your money, that destination could be anything: a cozy retirement, sending your kids to college, or just having the freedom to build the life you want. This explainer? Think of it as your personal guide to drawing that map, one simple step at a time.
And that's a totally fair question. I mean, you work hard for your money, you put it in a savings account at the bank. It feels safe, doesn't it? So why on earth would you risk that by investing? Well, as we're about to see, staying safely on the shore might just be the riskiest thing you can do for your future. So that leads us right into this really crucial idea: the huge difference between just saving your money and actually investing it. Your money needs a mission, because believe it or not, there's a silent threat working against your savings every single day. Okay, so let's break this down. Savings are for your short-term needs, right? Like an emergency fund or saving for a down payment on a car. It's safe, you can get to it quickly, but the returns are super low. Investments, on the other hand, are for the long haul. They definitely come with more risk, but they also have the potential for much, much higher returns. And that's what you need to build real long-term wealth. And here it is. This is that silent threat we were talking about: inflation. Put simply, inflation just means that things get more expensive over time. So the dollar you have in your pocket today, it's going to buy you less stuff next year, and even less the year after that. It's like this slow, invisible leak in your financial boat. All right, this is where it really hits home. Just look at the price of something simple like milk. What cost you about $2 in 2023 could easily cost you over $3.50 by 2033. Here's a cool little mental trick you can use. It's called the Rule of 72. Just divide the number 72 by the inflation rate, let's use 6%, and you get 12. You know what that means? In just 12 years, your money could lose half of its buying power. So you see, investing isn't just about trying to get rich. A lot of the time, it's just about making sure you don't get poor. Okay, so you're fired up, you're ready to set sail. I love it. But before any great journey, you have to know your starting point. You need a clear, totally honest picture of where you are financially right now. And the absolute best way to do that is to figure out your net worth. Think of it like your personal financial scorecard. It's a single number that gives you a perfect snapshot of your financial health. This is your "you are here" marker on the map. And look, the math here is super straightforward. On one side, list everything you own of value, your assets. That's stuff like cash, your car, your house. On the other side, list everything you owe, your liabilities, like credit card debt, student loans, a mortgage. You just subtract what you owe from what you own, and boom, that's your net worth. Okay, before we go any further, I need to put up a huge stop sign right here. This is so important. Investing is for your future, for the long term. But life happens, right? And for those unexpected curveballs, you need a safety net. Seriously, this part is non-negotiable. Before you even think about investing a single dollar, you need an emergency fund with at least 6 months of living expenses tucked away. This is your shield. It protects you from being forced to sell your investments when the market is down. All right, safety net is in place. You know your starting coordinates. Now, it's time to look out at the horizon. We need to figure out where you're actually going. Because without a destination, you're not really traveling, you're just drifting. And we want you to have clear, concrete financial goals. So to really chart your course, you need to ask yourself these 5 key questions. First, what are you actually saving for? Be specific. Is it retiring at 60? A down payment on a house in 5 years? Second, what's the price tag on that dream? And don't forget our friend inflation. Third, what can you realistically, comfortably invest each month? Fourth, how fast does your money need to grow to hit those goals? And finally, you got to be honest with yourself. How much risk are you really okay with? The answers to these questions are basically the blueprint for your entire investment strategy. All right, maps in hand, destination is set. Now for the fun part: picking your ride. We need to choose the investment vehicles that are going to get you there. And just like with travel, some are slow and steady, while others are built for speed and might give you a bit of a bumpier ride. And this leads us to maybe the single most important rule in all of investing: the risk-return trade-off. You've heard the saying, there's no such thing as a free lunch? Well, this is it. It's a fundamental truth. If you want the chance to earn higher returns, you absolutely have to be willing to accept a higher chance of loss. That's the deal. Understanding this is everything. So, what are these vehicles we're talking about? They basically fall into four main categories, or asset classes. You've got cash, which is super safe but won't grow much. Then there are bonds, which are kind of like lending your money to a government or a company. A little more risk, but better returns. Then there's property, a real physical asset for the long term. And finally, you've got equities, or stocks. That's owning a small piece of a company. They have the highest potential for growth, but also the most ups and downs. And things you hear about like ETFs or mutual funds, just think of them as convenient ways to buy a whole basket of these things all at once.
I know. This is usually the point where your head starts to spin a little bit, and that is perfectly okay. You might be thinking about getting some help, maybe from a financial advisor. But that brings up a really important question. How do you know you can trust your guide to have your back?
Well, there's this classic idea in economics. It's called the principal-agent problem. Sounds complicated, but it's not. Basically, you're the principal. It's your money, your goals. Your advisor is the agent you hire to help you. The problem pops up if your agent is motivated by something that's good for them, like a bigger commission on a certain product, but maybe not the absolute best thing for you. So how do you make sure you're both rowing in the same direction? First, be super clear about your goals. Second, ask them how they get paid. Is their success tied to your success? And this is the big one, the absolute game changer. Ask them, are you a fiduciary? A fiduciary has a legal duty to act in your best financial interest. It's a powerful way to make sure your goals are aligned from day one. Okay, let's get to the fun part, actually building the thing. We're talking about putting all these pieces together to create a portfolio that's going to work for you for years, even decades. This isn't about getting rich quick. It's about a smart, steady plan for the long road ahead. And the number one rule for managing that bumpy ride? Diversification. Look, don't put all your eggs in one basket is a cliche for a reason. Because it works. By spreading your money out across different types of investments, some stocks, some bonds, maybe some property, you lower your risk. That way, if one area has a bad year, it doesn't sink your whole ship. And here's something really important to remember. Your strategy isn't something you just set and forget. It grows and changes right along with you. When you're in your 20s, you have decades to ride out the market's ups and downs, so you can afford to take on more risk with stocks. But as you get closer to retirement in your 50s and 60s, you'll probably want to shift to safer things like bonds to protect the wealth you've built. Your portfolio adapts to your stage in life. You know, there's this great quote from Benjamin Franklin that says, an investment in knowledge pays the best interest. And hey, the very fact that you've stuck with us this long means you're already making the best investment of all, an investment in your own knowledge. That's the real foundation for building a better financial future. All right. We've laid it all out. You've got the map, you've got the compass. You know about the different vehicles you can take. Your journey, it starts right now. So my question for you is, looking at everything we've talked about, what's your first step going to be?